Well, welcome for you all to come, and I'll introduce the panelists shortly. Let me introduce myself. I'm Jeff Credline, partner and managing director at Hartman Executive Advisors. Hartman Advisors, we're a completely independent technology leadership and advisory firm. We work with mid-market executives to kind of strengthen the role that IT plays in supporting their business goals. So we have a great panel today. I want to get them to introduce themselves. But for us, a little bit about Hartman. Many mid-market organizations, technology, kind of primarily focuses on networks and systems things and the like. We help organizations ensure they have kind of a strong foundation and an IT strategy and position IT strategically. So we can allow our leadership to focus on business alignment, investment priorities, and disruption and innovation and the like. We are a fully independent firm, so we don't sell any hardware or software, which really allows us to sit on your side of the table and can really act on your behalf with our advice and recommendations. But enough about me and our firm. I want to turn it over to the experts that are here today. So why don't you guys give a brief introduction of yourselves and your firms. Glenn?
Yeah, Glenn Christensen, president of CEO Advisory Group. We like to think of ourselves as the eHarmony of the credit union industry. And we've been specializing in credit union mergers since the early 2000s, representing both the credit unions wishing to be acquired as well as those wishing to acquire.
Thank you, Glenn. Thanks for joining us. Jeff?
Hey everyone, pleasure to be here. Jeff Cardone, I'm a partner at Luse Gorman. We are a law firm based out of Washington, D.C., and we focus on representing community-based institutions, really in corporate, regulatory, and with a particular emphasis on transactional matters. We've been the #1 law firm in financial institution merger transactions for the last 5 years. We completed over 100 mergers. We're heavily involved in credit union mergers, credit union acquisitions of banks. We also have a very robust capital markets practice, so we do a lot with subordinated debt and secondary capital as well. So again, a pleasure to be here and pleasure to meet everybody.
Thanks, Jeff. Thanks for joining us. And Wade?
Hey, good morning or good afternoon, everybody. Wade Barnes with Hartman Advisors. I manage our financial services practice. So Jeff explained to you a bit about our firm. Within financial services, we're responsible really for working with the credit unions in the portfolio, really focused on a couple of things, really focused on helping to gain wallet share, market share, drive operational efficiency, and ultimately profitability. We, unlike Jeff and Glenn, we're really more on the backside of transactions like this. So our team really helps work through the integration of the two organizations once a deal has consummated. So welcome, good to have you all. We're looking forward to the panel discussion today.
Thank you, Wade. As I mentioned, guys, we want this to be more of a discussion. I'll facilitate, Jeff and Glenn and Wade to interact. But if you have questions, feel free to drop them in the chat, or frankly, just unmute and speak up, raise your hand. However you want to interact, feel free. Don't hesitate to stop us along the way. So just as a brief opening, I guess looking back last year, despite the appearance for pent-up demand for activity, M&A activity in credit union sector, 2020 activity was at a 10-year low. I mean, we really didn't see what we had seen in years past, right? So clearly COVID impacted just about every industry, and ours is no different. Credit unions have tremendous pressure. You all have tremendous pressure on performance that which we believe sets the stage for a lot of really healthy M&A activity this year and beyond. So to get us started, starting with probably Glenn, what do you think about macro environmental trends that are really driving interest in M&A activity today?
Yeah, I think on several levels. One of them is certainly the influx of deposits. I think has really impacted the movement as credit unions are struggling to be able to lend out that money at any reasonable rate. And together with the flattening of the yield curve, it's just put a lot of pressure financially on credit unions. And certainly during the time of the whole COVID situation, we saw the transaction volumes and income from fee income dropping off substantially as well. So we have those financial pressures that are occurring. But I think beyond that, I think if you look more longer term, I think one of the big things that has really happened within our industry here is that goes beyond the financial side, but it's a leadership issue. And I don't think we've talked a lot about that within the industry in the past, but much of this is really the size of the credit unions has gotten larger and larger in terms of the mergers that we see. Just this past year that, when we look at it, we had Firefly, merging into TrueStone, so $1.5 billion credit union merging up. Exceed here recently, merging into Connecta. And I think this is a trend that started about a decade ago when you had two very successful financial institutions with First Technology and Addison Avenue deciding, let's join forces. And both of them, $2 billion-ish type credit unions, both doing very successful. But they said, how could we do more to serve our members as a result of joining forces? And if you look at their performance numbers, pre the merger and post merger, you saw that they were both struggling somewhat for strong growth. But if you look after merger, you see their operating ratios suddenly, really improving substantially. Their net income increasing, operating expense going down, and their growth rate, took off like a rocket as a result of that. And I think that changed the mindset of leaders within our industry to say, maybe this is really a good idea to be looking at mergers in a different way. As in the past, it was always credit unions that were struggling that were the ones that were merging. Now, I think we're seeing more of a trend that credit unions are saying, well, how can we have an impact in our markets and really change the way that our members are receiving services at the time that we're seeing, tremendous change in the industry with digitization and so forth. But leading this too is just this influx of talent that has come into our industry in many ways. And many of them, have been in other industries in the past where there has been a substantial amount of mergers and are asking the questions, why shouldn't we be doing that here as well? And that has also then opened up the door to the bank acquisition side, and which is, again, going to have an enormous impact, I think, on the industry going forward. And then you have talented people, like the Jeff Cardone sitting here, that bring, just a wealth of experience in terms of the banking industry and how to do acquisitions in that area as well. And if you were to go back, 10, 20 years, this wasn't really on the radar for most credit unions, but with a new influx of expertise into the industry, I think we're seeing some substantial shifts as a result of that.
Thanks, Glenn. Jeff, Wade, want to add anything?
Yeah, no, I appreciate the kind words, Glenn. I agree 100% with Glenn said. I would say the big drivers to M&A, what's been going on now, is obviously the importance of scale, particularly when you're operating in a compressed margin environment. And certainly the talent piece, succession planning, is vitally important, certainly is a driver of transactions that we've seen. I know on the credit union credit merger, certainly diversifying your field of membership is of great importance. I think the American Banker today or yesterday put out a great article on that as sort of a theme that's impacting the credit union merger industry. And as Glenn said too, we've been over the last 5 years, there's been a huge uptick, in credit union acquisitions of banks. And it's a real strong strategic play for credit unions from what we've been seeing, because again, not only can you expand your field of membership, but you also have the ability to attract talent, broaden the, your platform, your loan portfolios, acquiring teams of talent, even outside of traditional, interest income. You can look at things like, whether it's fee-based businesses, wealth management, et cetera. So all that that trend has definitely, been a big uptick. And the one benefit now too, looking at the credit union acquisition of bank space as well, is there's now a regulatory regime for doing that. where we were involved in the first deal of a credit union acquisition of bank. This was back in 2013, and it was a bit of the wild west from a regulatory completion standpoint. And now, the NCUA has put out, sort of a roadmap and their proposed rules, governing merger process. So again, there's this framework out there. So it's no longer acquiring a bank is sort of the path of least resistance for credit unions. And I agree with Glenn. I would anticipate that trend continuing, particularly, sort of we're in a choppy economic environment, and the target banks that are looking to sell, cash is attractive currency to them, which obviously credit unions who are well capitalized, have strong networks, have an ability to pay.
Just to build on, I mean, I think we've got a good foundation here, and scale is really a big component here. I didn't mention in my intro, but I actually come from the other side of the table. So I've been in the community banking space my entire career until the past 3 years. So I know how tough competition is, and the competition, it's not getting any easier. Not only to compete against other credit unions and banks, but now there's non-bank, non-credit union organizations that are out there looking to steal deposits and loans. And the fintech world just continues to evolve. That marketplace is going to continue to be more and more challenging. So to the extent that you've got the scale to be able to invest in technology to really offset some of that threat and deliver a really meaningful customer experience. Amazon's just done us all some favors and some disfavors, right? The customer experience in today's world, frictionless is the word that I'll use. We've all just become very accustomed to this frictionless, buying experience, and that translates into the banking universe as well. So the demands on technology, consumers have much more expectations in terms of mobile self-service, but that doesn't mean that you can get rid of the branches either. So at the end of the day, the delivery costs are increasing, but yet there's not really that offset on the expense side. So the scale is a really big part of it, and the ability to continue to invest to remain relevant. I'm seeing that as a big driver as well. And also, we've seen a lot of M&A specific to fintech. So looking at companies who've created those joint ventures or ultimately have made an acquisition of a fintech company to give them that cutting edge.
Good, thanks. So then, understanding the desire is there from credit union leaders to engage in M&A activity, like, where do we start? Maybe I have to point that to Glenn as our online dating expert, as he described himself to get started. So what are the first steps?
Well, I think it starts with a plan, on the board level, and understanding what are really the end objectives of doing the merger here. And I think credit unions do mergers for a variety of reasons. But I think an important part when credit unions really start to think about whether or not they want to be in the merger business, it usually starts with, we want to be an acquirer. And whether you're 50 million or 10 billion, that's the initial perspective, is that we want to be that surviving credit union. So I think in the early discussions around this, it's important to be asking the question, should we also be open to being acquired? And then once you do that, to really put into place, if you're open to being acquired, also put into place a system where the management team feels comfortable having those discussions. And that means that there are some protections for them in terms of change of control agreements, for instance, that will allow them to be unbiased in their approach to evaluating each merger as it is. The other part is to really set goals and understand, if you do a merger, what is the end result of that, so that the board comes and evaluates the merger and says, were we successful or were we not successful in this merger, and having clear parameters around what does success look like. And then to understand, do you want to be, what type of an acquirer do you want to be? Do you want to just take opportunities that are presented to you by the NCUA, or do you want to be a more active acquirer and put forth initiatives to go out and seek on a continuous basis merger partners? And then understanding the pool of partners that you need to be looking at. I think one of the questions strategically that a credit union needs to ask in this, do they want to make mergers a core competency of the credit union as they move forward? Or is this something they're going to dabble in once every, 3 to 5 years, and then kind of reinvent their whole merger processes in that way? It's an important distinction, because if you set the threshold of the type of credit union you would consider as an acquirer quite high, your possibilities of acquiring very many and developing a core competency in that is going to drop, because now you're really limiting yourself to very few merger opportunities. I have some clients that say, ideally, we would like to merge in a credit union of, say, 100, or it could be 250 million, or maybe even 500 million. But they understand that that's their ideal target. But in order to have a core competency, they might also be willing to drop down to a 50 million or even a $25 million credit union, just to continue to keep a merger opportunities in the pipeline for them, to keep their integration teams busy with that. So I think those are important sides. I think if you're a credit union looking to be acquired, again, is to look at, what are ultimately your goals, and what are some of the constraints that you have as a credit union, and what type of a partner would you be seeking if you were looking to merge up. Often, I think you'll see that a credit union, will just merge with their buddy down the street, and they go from being a $20 million credit union, and now they're a $60 million credit union. Well, that $60 million credit union is also on the target list of a larger credit union to be acquired. So, do you want to really go through those serial acquirers? I think more and more we're seeing credit unions that are seeking merger partners, are seeking those with assets in that, in excess of $1 billion, perhaps 500 million and above, as the ideal partners that have the scale to enable them to achieve some of the goals that they're looking for.
A couple of things I would add to what Glenn said, and Glenn made some great points. Just what we always are, from a legal perspective, advise boards is really, maximizing your tools in the toolbox. So an example of that would be, if you're a credit union, whether you're looking to acquire a bank, or you're looking to potentially acquire another credit union, looking at things like, do we have the most advantageous charter, field of membership structure to execute on a transaction? From a acquisition of a bank standpoint, do we have the requisite capital to pull off a deal? And I will talk a little bit about sub debt, but again, just kind of maximizing your tools, being ready to pounce on an opportunity, I think is important. Certainly getting your regulatory house in order. If you have any safety and soundness issues with the NCUA or your state regulator, I mean, that you want to make sure you're resolving, particularly if you're looking at banks, whether it's whole banks or branches, et cetera. And then on the other thing on the credit union merger side, I mean, the most paramount issue that I think you have to work out is the social issues as well, whether it's board seats, management teams, et cetera. What's that going to look like? Because while, you look at the numbers and everything looks great on its face, when you kind of sit down, you can only have one, CEO, CFO, management team, the composition of the board, and all that, sometimes can lead to deals not coming to fruition. So I think that's important to work out, particularly early on in the process. And then, from the seller's perspective, if you're a credit union looking to partner or merge up with another credit union, I think, as Glenn said, I think it's vitally important, because there's going to be a monthly, regulatory approval process. You're likely going to have a member vote for approval. How do you incentivize your key people to stay? Whether you have, severance arrangements for, change of control agreements, et cetera, for your important folks. I think that's important. We've dealt with issues too. If you're in troubled condition, if you have safety and soundness issues, you're trying to work through that with the NCUA, kind of getting that house in order as well, is all, vitally important from a deal perspective.
Just building on to Jeff and Glenn's response in terms of looking at your regulators and the external parties that you've got to manage here. Think about the internal capacity to get a deal done too. Either you've got the team that can execute on that, or make sure you're finding the right partners that can help you execute on that. It's a heavy lift, and we've seen a lot of times, organizations get into this and it becomes a mess very quickly, or it leaves years of cleanup, which has a counter impact on what the intended goals were. So looking internally, thinking about confidentiality, obviously this is a highly confidential transaction. So think about how to handle that as we go through the process. But if you're thinking about, especially from the seller side, think about your contracts. It may seem really attractive today to sign a 10-year deal with your core to take advantage of the discounts there. But let me tell you, those breakup fees will kill a deal down the road. So be really thoughtful about contract terms, not just with the core, but even simple things like telecom. There's no reason in technology today, with things changing so fast, just be really, really cognizant of that. Another thing to think about too is digitization of records. So no doubt there will be diligence periods, loan reviews, to the extent that you can get a lot of that digitized to keep a lot of that from being in person. Obviously, the last year has made that really difficult, but to the extent that you can make that a more efficient process by making sure you've got loan records digitized and able to be able to share, online, that's really helpful. I think the last point I'll make here is, especially as you're thinking about and getting closer to a deal, it's the cyber component. Cyber is just really, really, really important to address as you get through the process. So those things that are coming to my mind to add on to the answers already stated.
Thanks, guys.
And I would echo too with what Jeff was saying about looking at your field of membership and whether or not they have the correct charter to be able to really be an aggressive acquirer. Often I find we're in merger situations and the acquiring credit union just does not have the field of membership to be able to execute on that merger, and so puts them behind the ball in terms of being able to move forward. So I highly encourage credit unions to take a look at that. And I know that has been really one of the first steps that some of my clients have taken, is to say, boy, do we need to move from a federal community charter to a state community, or to move to a seg charter in order to be more, have more options from a field of membership standpoint.
Yeah, the other thing I add too is if you're low income designated, that is hugely advantageous in terms of effectuating a transaction, both on the bank side and the credit union side as well. So if you're not, and that's something, if that's a designation you can get, I would strongly suggest pursuing that, particularly if you're thinking about, acquisition growth. And, as Glenn said too, with charters, a lot of it depends, like some states have much more flexible field of membership requirements, and others are more rigid. So as Glenn said, I think that's vitally important and something should be considered as well as you start thinking about, potential geographic areas of expansion, et cetera. And also seg-based charters tend to be better, or you tend to, in terms of memorizing, whether it's a target bank or credit union, in our experience, than actually the community-based charter, which seems counterintuitive, but we've had much more success with seg-based charters than field of membership, than community-based.
And I think kind of going along with that, there, more and more credit unions are looking at multi-state merger strategies. And in looking at that, again, how does your field of membership play into a multi-state charter? And I think that, especially with digitization of the world here, I think it becomes a real critical element.
Yeah.
Good. Okay, so then, as discussions evolve from idea to action, Jeff, what are other sort of legal ramifications that this group should be considering as we look to move this forward and kind of protect their interest?
Just to kind of build on one thing, I'm kind of interested. So with credit, and again, just to echo what I said earlier about maximizing your tools in the toolbox, right now out there is subordinated debt and secondary capital, and subordinated debt is not it's not really a new concept. It's been around since the 1990s for low income designated credit unions. It's called secondary capital. but the NCUA has implemented a final rule. It's going to take effect in 1/1/22. It basically expands the pools of credit unions in terms of who can issue subordinated debt, which is really just a fancy, for those of you not familiar with it, it's really just a borrowing. So you as a credit union would borrow funds and it gets favorable regulatory capital treatment. That's really what subordinated debt is. So in terms of just legal random things to think about, again, if you're going to be acquisitive, particularly if you're looking at bank or bank assets, I think considering some sub debt or secondary capital should be part of your strategic plan. And unlike banks, so banks, it's very prevalent in the banking world, sub debt. They can do it quickly. It typically done in about 4 weeks. Credit unions, conversely to that, you have to get NCUA approval before you can issue sub debt. So what you can do from a strategic standpoint is, and I highly recommend this to credit unions, is get the pre-approval from the NCUA and your state regulator, and then to the extent you need sub debt or secondary capital, you can just go and get it done, rather quickly. But if you kind of wait until you actually need the capital, then a 3-4 week process turns into a 5-6 month process. So again, maximizing those tools in the toolbox, I think again is I can't emphasize that enough, just from a capital perspective. And other legal things too, again, really in the credit union merger space on the sales side, a lot of times deals come to fruition and we've been involved with where there's no real legal merger agreement other than the NCUA's form. And I just think for credit unions, just be mindful of, there's certain important things you're going to want to get from an acquired credit union, things like indemnification protection, insurance coverage, severance protection for your key employees who may not be offered a job post-transaction, things of that sort. So while it's a little bit different process, where on the bank merger side, it's very more formalized, you much more detailed, definitive agreements. The credit union merger is not the case. I think things like that are important to get as part of the process. So again, something to kind of keep in mind before you sort of decide to merge with somebody and you're just like, yep, we'll just go in for the approval. So that would be recommended as well. Thanks,
Jeff. So as we evolve, go ahead, Glenn, you have something to add?
Yeah, I was just going to say, just with the sub debt, I think that's a particularly important issue for credit unions to look at now, especially with the influx of deposits that we've seen and the net worth ratios decreasing. And especially if a credit union is looking at potentially acquiring a bank, their ability to acquire, typically, we'll see credit unions are acquiring banks that represent maybe 10 to 20% of their asset ratio. And because you cannot bring over the capital of the bank onto the balance sheet of the credit union, the net worth ratio is being depleted. Having a sub debt allows the credit union the ability to stay above their minimum thresholds in terms of their net worth ratio. So I think it's an important strategy for credit unions to look at as they move forward. And we're certainly seeing larger and larger banks being acquired by credit unions. So I think it's an overall important strategy to look at.
Yeah, I would sub debt and capital. Like what typically happens, if you put yourself in the shoes of a bank who's looking to sell and have a liquidity event, they generally, if you're a selling institution, you generally want to minimize contingencies. And, on the credit union side, when you're looking in the bank, one of the key factors, what are we going to look like, from a net worth, pro forma capital, regulatory standpoint. And so the way you can utilize sub debt, it's not necessarily going to be linked to the deal itself, but, sort of building on what Glenn said, if let's say you have a market where we don't want our net worth to drop below 9%, and maybe if you buy a bank that is real from a strategic standpoint makes sense, takes you below whatever, threshold you may have self-imposed, you could then go out and access the sub debt market to kind of recoup that regulatory capital loss. So that's the real benefit of utilizing capital as part of it, or in concert with the transaction.
Good. Let's pivot the conversation a little bit towards diligence. And as you enter that period, in addition to loan and deposit review, which is, sort of table stakes and when diligence, what else should we be considering, when evaluating a target? Things that might be not top of mind. Wade, you mentioned earlier, you mentioned earlier, oftentimes we're brought in the integration side. I know you and I always often say, man, I wish we were involved a lot earlier. We would have advised this. Like, give a couple of those examples, Wade.
Cyber, I mean, I spoke to that earlier. That's a big one. Do a review of the target. I mean, there's so often times we get in, we find out there's been a cyber event, something that's active, and it's distracting. It can be costly. It's just a distraction. It's probably the best way to put it. Contract terms, I'm going to go back to that. Make sure you really understand the contract terms. Make sure you understand the notification dates. Make sure you understand the costs associated with that. Those are just some really, really big components as you work through it, and not having a good grasp of that will cost money, and it'll cost time to work through. Those are the big things. Understand the systems too. Understand all the different systems that the organization has that you'll be integrating, and what that integration plan is going to look like. Start to create that far enough in advance, and then just be thinking about communications. I mean, so much of what we've talked about so far is it's a social event, right? So start to have that in mind, and think about how you'll start to navigate that.
Yeah,
Go ahead, Jeff.
I was just going to add to that what Wade said, and this is probably greater importance if you're looking at bank assets, is really assessing, any potential impermissible assets of the target institution, or anything that could, for example, you may be up against your member business lending thresholds. You may have to offload commercial loans. So any of that stuff that could kind of impact sort of the enterprise value of the institution you're acquiring, I think is also important. Looking at the potential customers, like for example, there's a lot of relationships at banks where a customer has a loan relationship, but they don't have a deposit account with the institution. So that has to kind of be factored in as well. Any potential runoffs, et cetera. When you're sort of evaluating, a potential transaction, its value, and how it's going to look, how accretive it's going to be to your institution. I think that's important as well from a diligence standpoint.
And I guess Wade has mentioned this a couple of times, and I'll mention it a third time, and that it deals with the contract issue. And if you think about how a credit union acquirer of another credit union looks at a transaction, typically they see that there's a pool of money that they're going to use to support the members in the community. And then the more money that is being absorbed for contracts, the less money there's going to be available for paying the employees of the credit union retention bonuses or severance bonuses, for supporting marketing efforts or community efforts. And so I think it's really important to strategically, so if a credit union is thinking that a merger could be a possibility in the next 5 to 10 years, that they really need to be very cautious with how they negotiate their commitments to the core processor, because if you're paying the remaining term on a 10-year contract, that's could either derail the merger entirely, or it's going to really take away from the benefits that can go to the other stakeholders in the merger. So probably one of the biggest things that we see that will derail a merger.
The other thing I would add too, I forgot to mention, and I think Wade was talking about this with contracts on from an exec comp standpoint, is there's this new excise tax, 4960, I believe, that came out ironically in the Tax Cut Act, and it's an excise tax imposed on the credit union if there's sort of excess compensation payments made to certain individuals. So that's also something to be mindful of, particularly if you have a target credit union with CEO has a large 457F plan, or there's a bunch of golden parachute arrangements. That can impact costs as well, and particularly now that you have this excise tax. I know in a lot of transactions we work on, we quantify that, or we'll kind of assess that, and that does have an effect on transactions as well.
One other thing that came to mind as I was sitting here taking all this into just from a execution and maybe even a strategic perspective is look at the product mix between organizations and really think about how the products will match. So often we'll get into the tactical side of mapping, right? The mapping exercise of what goes where. One, you don't want to have a ton of grandfather products. It makes that really difficult. You don't want to have to overexpand your business line unless that makes sense strategically. But if there's some significant gaps between products, that can create some issues, especially as you start thinking about member retention at the end of the day.
And on the compensation side too, I think one of the important things for credit unions to consider, oftentimes, a credit union holds on from moving forward with a merger as the acquiree too long. They let their financials deteriorate. And if it deteriorates too far, if they go from Campbell 3 to Campbell 4, the ability to actually compensate the executive team is significantly reduced. And so I think it's really important for the CEOs of credit unions to be mindful of making sure that they think about a merger well in advance of them deteriorating financially. And the reality is you get a lot more in your merger negotiations when you're financially strong than when you have a deteriorated financial position.
Yeah, Glenn, that's a great point, because I'm working with a credit union and they're in troubled condition. So not only does that put handcuffs on the institution's ability to pay severance from a safety and soundness perspective, from a legal standpoint, to pay severance, you have to get approval from the NCUA. So add sort of another layer. And there was and we ended up getting regulatory approval, but it was impactful from a deal perspective, and certainly caused a lot of heartburn for the execs who worked very hard for getting the institution to where it was and to find a merger partner. And their severance was at risk. So as Glenn said, I think it's important. You always want to be in a position of strength from a financial perspective, even if you're a seller, than waiting till the end, because it does have legal and safety and soundness implications.
Thanks, guys. Glenn, heading back to you. I mean, I know we had a discussion internally about the best strategies around member vote. Talk us through some advice there on how to look at that.
Yeah, I think there's a couple of sides to it. Number one, I would say, don't take a member vote for granted that it's going to go through. You look at most merger votes, they go through and they clear fairly easily, and you have 10% of the members vote, and perhaps 95 of them are voting in favor of the merger. But that doesn't always happen, and even in the last year, we've seen a couple of mergers that did not go through during the member vote. And I think one of the vulnerabilities that credit unions have is social media, and that using social media, members, you might have a disgruntled member that can communicate against the merger, using that as a tool to derail a merger. I'm working on a deal now, and one of the big risks that is foreseen is that it's a very tight-knit group and organized group of employees, and how will they respond to the news of the merger. And so the feeling is that there's a threat of the use of social media to perhaps derail the merger. So as the credit union is strategizing about this, making sure they have the right team in place, have a PR strategy and a PR specialist in place to address issues that might come up and be at the forefront of it. Being able to monitor the social media that is out there concerning the merger, I think becomes an important part. And then communicating. I've had some credit unions that in difficult markets, especially in smaller towns where people are close knit, where they've even had booths set up at the the farmers markets and so forth, just to get the word out and make themselves part of the community as they're moving into these new communities. So having a very comprehensive marketing plan around the member vote, I think, is an essential part. And I also think having electronic balloting is an important piece of it. I think we tend to see more favorable votes that come through online votes as opposed through the mail votes. So certainly highly encourage credit unions to consider using electronic balloting as well.
Yeah, and I would add too, I think to what Glenn said, you also, it's of great importance, particularly, with a credit union emerging out of existence, to have strong buy-in from the management team and the board. And this then adds to the, sort of the importance of a transaction document. Obviously, you can't force the behavior of individuals and the buy-in, particularly of a target director or a management team, but you do typically see, or we would put in covenants, that they're going to recommend in favor of the merger transaction. Certainly, they're not going to do anything that's going to, submarine the deal, et cetera. And there's some legal ramifications in there. And again, that just adds sort of a layer of protection. Again, this is particularly from the buyer's perspective or the acquirer, just so that if you're undertaking all this time and expense, you just want maximum buy-in from, the target board and management team in terms of getting the deal done.
I'm just going to add to this too. I mean, Glenn, you mentioned the communication piece. It's just so important. And if you think about it, the frontline teams are just so important here because they're the ones that have, member facing interaction, and to really make sure everybody understands, why the transaction's happening, what the details are. No doubt, people are coming in and saying, what's happening to Mary, the branch manager, and the teller team. That's always a question that comes up. If they're prepared to answer that question well, and they're feeling comfortable about the transaction, they understand the benefits, that goes a real long way as well.
Agreed.
So Wade, I mean, once the deal is struck, talk us through the right strategies to most appropriately integrate the two organizations. We've hit on a lot of it, but if you sort of said, look, for organizations that have not done this before, here's where you'd start.
Yeah, it's a great question, Jeff. I mean, one thing, if you're a serial acquirer, you've done this a million times, you've got a script, that's great. Don't assume that this one's going to go the way the last one went, because as many as we've done, I've never seen two that are exactly alike. Something always comes up that's unique. And if you've never done it before, you need to have a playbook. Let's just start there. I mean, it's really, really important that you've got that playbook and you're following the steps, because there's a lot of pieces and there's a lot of things happening at once in concert that need to be coordinated. We mentioned contracts. If you didn't get your hands on the contracts or do your diligence before it's consummated, certainly do it now and start to work through the, any notification periods that are required. Start on the employee selection as fast as you can. Try to be as transparent, communicate what you can as you know it. I know that's difficult, but I think, being transparent there helps with the communication part we just talked about. And we've talked about cyber. I mean, oftentimes you don't get an into, the networks and the organizations until you're farther down the path. That's the right point. You got to do it. You got to make sure you understand the environment, and if there are any risks there, start to deal with them. But then very quickly, it turns into the things we talked about in terms of products. I mean, you've got to start taking a look at the products, start figuring out if there are product gaps, how you're going to solve for that. That might require new relationships. It might require, assuming relationships from the acquired organization, but start building that out. Data mapping, that's a huge part that you need to start working through. Make sure you know how your data is going to translate from one place to the other. And then it's really about communications to the members. You've got to make sure, oftentimes there will be things that have an adverse impact, not intentionally, maybe not even material, but those require certain disclosure. So you've got to make sure that you're disclosing that in advance. But more than disclosing any adverse impact, it's really about making sure the members understand what's happening. What do they need to do? Are my bill pays going to come over? Do I have to reestablish them? Things like that. So you really want to make them feel welcome to the new organization. So taking that proactive communication perspective, it's really, really important. And then you get into testing. It gets into quite literally testing the data files from one core to the other, making sure things validate, doing any remediation, and ultimately preparing for the big conversion weekend and having the appropriate staff on board. It's amazing. 20 years ago, you'd do a deal and it would take 30 days before people get their statements to realize that something happened. In today's world with online banking, inevitably something doesn't go well over conversion weekend, whereas before you had the 30 days to clean it up and figure it out. Now it's 9 o'clock Monday morning, your call center is blowing up. So you've got to make sure you've prepared for that, have some extra support there, because no doubt there will be an influx of calls for the first week.
And I'm going to add to, early on in the process, once you get through the legal submission to the NCUA, one of the first parts in this whole process is really the communication to the employees, right? And getting them on board, and because they become so instrumental. So HR, I would say, is one of the very early players in the whole process of as you move into the integration phase, and in understanding, what are going to be the implications to the employees on day one. And once you announce it to the staff, what I have often seen is that there's an initial excitement among the employees, because now suddenly they have much more competitive products, there's some new opportunities. And then they go home and they think about it, and then they go, oh my gosh, who am I going to report to? And how is this going to impact my benefits, and so forth. And that's a real tough period of time in the whole merger process, is those first few days, and making sure that that is done properly and through the proper communication, and having the right people involved in the communication to the staff at that initial juncture there, and so that they feel safe and trusted in terms of what's going to happen to them in the future. And I think credit unions have been pretty good about ensuring that not only are all employees going to be retained. I mean, that's become almost a necessity of mergers. A little bit more complex when you have mergers of equals, but and then I think too that it's become more common for credit unions to offer retention bonuses, and to give some sort of a financial incentive to the staff as a result of this. Plays an important role. But ultimately, the success of the merger is going to be contingent on how many members you're able to retain through this whole process. To retain those members, you have to also retain your staff, because people do business with people in our business, and having those people feel comfortable with the members, feel comfortable with the transition, and the staff support that, I think, is really such a critical element to the success of any merger.
Two real quick things I would add to Wade and Glenn's point. One, I mean, that's always the challenge and the balance of what Glenn said. It's assessing culture. You're balancing culture versus, price metrics, deal metrics, cost saves. And that's a challenging balance, particularly in credit union mergers, because the culture piece is vitally important. Even if you say, oh, well, if we eliminate X number of employees, we're going to extract X amount of cost saves, et cetera. So I think preserving that is important. And then the second piece, to build on what Wade said about planning, I mean, we are in a pandemic while everyone's getting vaccinated. So the communication piece, that was one of the great lessons learned doing deals during COVID, is communicating. As Glenn mentioned, the HR is very important, and having that communication. While the communication piece is much more challenging during COVID, because it's more difficult to meet in person, et cetera. So again, having a plan and how you're going to deal with that, and making sure the lines of communication are there, again, are vitally important from an integration standpoint, from what we've seen.
I want to pause here. We have about 5 minutes left. Is any questions from the group for the panel? Okay, just want to make sure everybody has an opportunity. So as we wrap up, guys, what are some, we've talked about contracts a couple of times. That's come up several times already, but outside of that, what are some other pitfalls? What are some things that have sort of killed a deal, that we can start preparing for, that said, what, had we known that would have been a potential pitfall, we would have planned differently? Anything come to mind?
Well, the one thing I would lead with, I don't know if this is with kill, but one particularly if you're on the acquisition side, and Glenn and I talk about this all the time. If you're a credit union and you're looking to grow via acquisitions, and if we consider exploring banks, I think one thing to keep in mind is that you want to be sort of known out there as a potential acquirer, because a lot of times what happens when banks sell, the old adage, banks are never bought, they're sold, is, they're going to reach out to potential merger partners through their advisors, and you want to try to get yourself on that list. So at least, and again, you don't have to move forward or actually do the deal, but you want to, if there's a potential opportunity, you want it to be brought to you. And I think that's important. So being proactive, again, talking, because Glenn's got a lot of great relationships. He's a great starting point. We on the legal side know a lot of people as well. But I mean, I think that's vitally important. So I don't know that necessarily that creators deals, but if you want a deal to come to fruition, I think that's important. And then, the flip side, even on the credit union side, again, just reaching out and having conversations, having dialogues, with if there's a particular institution in your geographic area that's worth, you may think would make a lot of sense, call CEO up and have lunch and start the conversations. I mean, a lot of deal making happens in what I would call those more informal channels than, more formalized process as well. So I think that's important too, as you start exploring, acquisitions, to sort of think about it in those lines.
I would say, I think it's really important to look at the whole governance side of things. And on a couple of bases. One is on the compensation, because, boards, they always seem to have a lot of quote unquote compensation specialists, and, their company, they do severance and it's, 6 months and that's it. But you have to recognize in this industry that, if you want a merger to happen, the CEO of a credit union is not going to be very enthusiastic if they're going to see a loss of income. And so there has to be a reality that among the board of the acquiring credit union, that you're going to have to compensate a CEO to go through the merger process, whether they stay there or if they elect to retire. And then I think also really important is who's going to be on your merger team from an internal perspective. I've seen where some credit unions, all the board members want to be involved in negotiating the deal terms. And, that's a recipe for disaster. You have to be very selective of who you're going to have representing the credit union in these merger discussions, especially when there are mergers of equals, and trying to navigate those, the personalities of the board. And I think it's also really important in those cases, especially in a merger of equals, just having a, third party be part of that, because there's a lot of chances for these deals to fall apart in the mergers of equal, and you kind of have to have someone that has been through this before and has the patience and understanding to try to keep things together through the whole conversation. So I think that's some of the pitfalls that I have seen is you get some personalities on the board that are a bit too strong, and things start falling apart as a result of that. So you have to be careful there.
Glenn?
Yeah, I mean, that's a great point. Just to reemphasize, I mean, the social issues are paramount, particularly credit union mergers, and particularly further if it's more MOE type transactions where you have two institutions of similar size coming together. You have to work that out, whether it's compensation, board seats, what the combined institution management teams are going to be. I mean, that is absolutely paramount to a successful deal. On the credit union acquisition of a bank, obviously, most importantly is going to be pricing. That's going to trump social issues, but don't downplay the social issues as well in that context as well. I mean, it's also, vitally important.
Jeff and Glenn, you guys both alluded to this, but I mean, and I know this sounds self-fulfilling to some degree, but you've got to have trusted partners to help you work through this. All of these, whether you've done it a million times, again, they all have a unique component. I mean, whether you're, talking about Glenn and finding the right partnership, creating that right partnership, Jeff, making sure we've got the right transaction details and, everything is, documented the way it needs to be, or whether it's on the execution side, it's really important that you're working with partners. This is a huge strategic decision for the organization. There's a lot of cost, and yes, there are costs in working with experts in this space, but that ultimately can save you a lot of money and time throughout the process. So I'll just add that to this as well.
Great.
Guys, we're up on 1 o'clock. I appreciate Wade and Glenn and Jeff. Thank you guys so much for being here and being engaging, and the group. Thank you all for your time. Time's precious, so we appreciate you all joining. We'll reach out to each of you individually. We're all here to help. If you have follow-up questions, any way we can help after this, we'll send out ways to get in contact with us.
Great. Thanks, everyone.
Thank you all. Have a great day.
Very good.
Thanks a lot.
Thank you.